now joined by John Loos, Property Sector Strategist at FNB. Thank you so much, John. And every time I see you, the number keeps getting better and better.
Yes, I must say it's pleasantly surprised me. I'd expected to tick along in lower single digits price growth, up to 8% now from a revised 7.1% year-on-year growth rate in February. So it's high single digits. It's probably above CPI inflation when we get the March number.
So
that means some sort of real growth.
I mean, it's up 0.9% from a real perspective. So you have to take inflation into consideration.
Well, yes. I mean, us economists like to look at things in real terms. So in real terms, we're into positive price growth. It's not wonderful yet, but certainly I think what it's reflecting is some pickup in the economy. We've seen both the global and the local economy going through a bit stronger growth in the last quarter or two. I think that's coming through into stronger housing market numbers. And I think too there's a bit more confidence on the part of borrowers and lenders alike to take on more debt or to give more debt. That's my perception in the market, is that home loans banks might just be gradually relaxing and that's playing a role in stimulating some demand growth as well.
What's interesting is when the inception of the FNB House Price Index in 2000, from then, we've actually seen in July 2000, real prices were sitting at 69.4%, higher than what we've seen in February 2012. I mean, it's insane if you just look at the difference. Are we ever going to get back to that level?
It is insane. A lot of people ask that, and some people, the sort of property bears, tend to think that we need to deflate all the way back in real terms to the levels that were achieved before the boom started back in about 98, 99. I don't think so somehow. And the reason why I think over the long term real prices must gradually rise. They won't do so smoothly. It'll be cyclical, and at the moment recently they've been going down. But I think real prices have to rise because land scarcity around metro areas or serviced land is becoming more of an issue. And how we adjust to that is we'll have smaller and smaller and smaller houses being built as time goes by, so that people, to address the affordability issue, not by real price drops.
We're sitting in an environment where we've got the interest rate sitting at 5.5%. It's a 30-year low. We know that core inflation is starting to tick up. Headline CPI sitting at 6.1%. We even hear mutterings of economists saying we could actually see an interest rate hike as early as the end of this year. Some say early next year. Is this going to have a significant impact on the overall housing market?
I think it still would, and I think households would best, and lending institutions best, be prepared for the next rate hiking cycle, because what I'm seeing, if we cut through all the low interest rates, are masking a lot of financial frailty in the household sector still. It's still a highly indebted household sector, although the debt ratio is coming down. But if we look at other survey numbers that we do, still about 20% of households selling in order to downscale due to financial pressure, according to our agent survey. That's financial pressure in my book. So I think a lot of it's being masked by very low interest rates. Rates will rise at some point. We know that. I don't think quite this year, perhaps next year. And yes, I think that will cause significant weakness in the market again when it does happen.
Okay, so when is the right time to buy then, John?
I think a very good buying time is going to be the next time interest rates peak.
But you're shooting yourself in the foot, because you'd be buying at a much higher interest rate.
Well, whether you buy at low interest rates or highs, you know, if you're borrowing if you're taking out a long-term loan, you're going to go through a few hiking and cutting cycles in any case. So you've got to be prepared for it. But I think that the market will weaken significantly the next time rates rise, and at the next peak, I think that it will possibly be the bottom of the big cycle, that long 15 to 20-year cycle. After that, by the next interest rate cutting cycle, I think by then the household sector will be significantly healthier financially. You've got its debt burden more under control relative to income, and that then we could be in line for a more significant price growth session. But that's somewhere in the second half of the decade, I think. But next hiking peak, I think, will be a pretty good time.
Okay, so let's also just quickly touch on the global scenario and how sensitive are we to any big shakes coming through from the Eurozone or even the US?
We are very sensitive. If one looks at the value of South Africa's exports, it's near to a third in value of our GDP. So we're an open economy. Exports get hit by any shocks to the world economy, and it's still a very risky situation. And yes, the economy is the housing market. So if your economy goes into a recession, hypothetically, yes, the housing market would be knocked.